Bond yields are very low for a couple of reasons. Obviously, the pandemic has put a tremendous amount of pressure on the economy. Growth has slowed dramatically, and the central bank is easing policy. All of that has translated into a dramatic decline in yields. And I'd say, sort of looking forward, the expectation is all three of those factors are still very much in place. And so for the 10-year-old, yields are low, yields are likely to stay low, and you should expect relatively low returns, from your fixed income portfolio. That being said, bonds as an asset class have done very, very well this year and have been kind of the anchor of an investment portfolio. Again, something that we would consider kind of going into the end of the year.
Yeah, I mean, the price appreciation has certainly given you some returns. I saw that high yield bond spreads have absolutely collapsed, meaning you can make a lot of money that way. But Jason, let me turn to you, because the landscape that George paints is one of a kind of slow, difficult economy, and one that some days we all experience. Then you have the other side of the coin, which is the ISM report comes out this morning pretty strong. New orders look really good, and it's hard to kind of reconcile that with what the bond yields are telling us about macro. So what would your advice be for investors here?
Yeah, sure. I think George's statements are all correct. And what you've noted is that bond returns have borrowed a lot from the future in the context of now having very low yields and very low future returns. When you think about ISM, just remember that that's relative to previous periods. So we saw a huge decline and now a stabilization. So it's not necessarily a huge bounce back. It's coming back, but it's coming back slowly from very low levels. So still a lot of potential for volatility. And with regard to what's going on in fixed income land for credit, still a lot of bankruptcies. We saw 2 more over the weekend. Right,
on the retail space. I wonder, though, Jason, if big tech is also borrowing from the future. Let's show the market caps of some of these companies again. Apple's at $1.9 trillion today. We're within a couple of percentage points from it being a $2 trillion company. Microsoft at 1.6. Amazon's up there. Then Google. Facebook's not quite at the threshold yet, but the digitization, so to speak, of the economy has accelerated. And to some extent, didn't we just borrow that from the future?
I think that's absolutely right. I mean, you remember when companies struggled to get to that $1 trillion market cap? That was a sell signal for a company getting too big. Well, we've blown through that a number of ways. The thing to look at there is really PE, right? So if you think about the PE of these companies, they've grown dramatically. Now, of course, their earnings have also grown. And they're the companies that are obviously best positioned. You had a big segment on Microsoft, best positioned to take advantage of the digital economy going forward. But the reality is the PE is really an indicator of what an expensive price investors are paying. And with the very large market cap that exists for those companies, they are increasingly huge weight in major indexes like the S&P 500. So investors really need to keep an eye on that, because if they buy broad-based indexes, they're buying those companies by and large.